take a few of these things in turn. Let's start with the minimum corporate tax. 15% is it seems to be the number that they've agreed, although some voices suggest they want it to go higher. We still need to get G20 agreement then, and then maybe this goes back to the OECD, some 140 countries maybe in conversation there. I mean, how many countries would need to sign up for this for it to have the desired impact? If the desired impact is to make sure that many more businesses pay the corporate tax rates that governments intended them to?
I think, firstly, most countries will sign up to this. So where the G7 goes, the G20 is probably going to follow, because I can't really think of any members of the G20 who would not be in favour of this sort of change of direction. Where the G20 goes, well, they delegated the programme, the details of this, to the OECD. Most OECD members will sign up. Actually, the way that this so-called Pillar 2, so this global minimum tax, is set, you don't have to have every country sign up for it to work, because there are two ways that this works. First of all, if you're the parent company jurisdiction of a group that is paying tax at a lower than 15% rate, then you can collect that top-up tax. But if the parent company jurisdiction isn't one of those countries that signed up, they've opted out, let's say it's a tax haven somewhere, then other countries, if they have subsidiaries that are paying one of those low tax companies, then they can collect the tax too. So it's actually quite hard to get out of, and you won't need 100% consensus to make this work.
That's actually really interesting then. So that answers questions about whether there'll be certain tax havens that would be able to sort of live on as that after this. So that's interesting, Tim. Let me ask you about the ability to tax, maybe tax revenues, or however this is in the end worked out, but the ability to tax businesses in the locations where they operate rather than where their headquarters are for profit purposes. This has been something, this is the other pillar that the OECD has been working on for some time. And I was looking at the wording, and I wondered if you could help us understand what it means. It says countries where big firms operate would get the right to tax at least 20% of profits exceeding a 10% margin. So what does that mean? For example, France's ability to tax Google, or Germany's ability to tax any other tech name. I mean, how is this going to work?
OK, first of all, it's not just tech companies. So I know this was targeted to try to deal with a concern around what tech companies were doing, but this is potentially a lot wider. However, it is for the biggest companies in the world, and companies that have more than a 10% profit margin. So although there's been talk about 100 companies, I suspect it'll be a bit more than that, but this isn't everyone. How this is going to work, this is really about, it's kind of turning corporation tax, which has been about profit in the past, into something that's sort of partly about profit, but it's partly about sales. And it's shifting where you pay your tax to where your customers are, rather than where the people who come up with the decisions, the innovations that drive your firm. It's where your customers are. The mechanics of this, I'll try to keep this quite simple. If globally you're earning more than a 10% profit margin, bear in mind all of this is subject to the details and to what finally gets agreed, then anything over and above that, calculated on a global basis, goes into a pot. And that pot is allocated out in a different way from how profit is allocated under what we call our transfer pricing rules, our normal rules. So that extra is sort of floating profit, which can then be allocated essentially based on an allocation key around your customer base, the size of your market. So if you're a country that has lots of customers that are driving sales and therefore profit for one of these multinationals, then you get to win. And the countries that didn't have a big customer base but might have had, for example, a lot of R&D going on, a lot of headquarter decision making, well, they're the relative losers.
OK, that's a really good explanation, Tim, so thank you for that. Do you think that then countries that have imposed, I take on board what you said about this isn't just tech, and but we have heard, for example, from Japan's ASO saying that most of the 100 firms, in his view at least, would be US-based. We have to see. There could be some big European names in there as well, maybe some other Japanese names. We'll see how they define these top 100. But given what you've said there, what is the impact going to be on companies that fall into that bracket? How big a change is this going to be? How revolutionary is this going to be for those businesses?
My personal view, not very revolutionary. So for a start, as we said, this is quite a small number of companies. They already assess profits and pay tax in the jurisdictions where they have major sales. Actually, some of the more sort of fully fledged tax planning structures that were around before the so-called BEPS-1 project a few years ago, most of them have gone, particularly with the US tech giants. So they're already paying tax in those countries. This shifts things around a bit, but not massively. I actually think the global minimum tax is probably the more radical of the two solutions. It's certainly the one that's going to have a wider impact too. What it will mean, of course, is that their in-house tax teams and their advisors are going to have lots more calculations to do, and there will be lots more arguments amongst tax authorities as well, because there's judgment calls involved in this too. So it's not quite so straightforward. You'll still see arguments between country A and country B about who gets what share of the pie.